The US stock market is down about 3% this past week, down close to 5% year to date, and down almost 10% from the most recent all-time high back in February. Now, as bad as that feels, the US stock market is still up close to 10% over the past 12 months. The S&P 500 is actually just back to what it was back in September of 2024. But I think there's still this looming sense of uneasiness right now that everybody's feeling. So I want to talk about some of the factors that led to this and more optimistically, some reasons to not despair completely. Now, it's important to remember that the stock market is really just the culmination of predictions from millions of investors. So the driver of market movements can be attributed to many things, but here are what I believe to be the big ones. Number one is tariffs. Now, I'm going to do a rapid fire of the Trump tariff timeline because it's not what this video is about, but I think it does show why we're seeing a lot of volatility in the market, particularly over the last few days. So here we go. February 1st, President Trump announces a 25% tariff on all imports from Canada and Mexico and a 10% tariff on imports from China. Those were set to go into effect February 4th. February 3rd, the US agrees to delay the tariffs on Canada and Mexico for 1 month after both countries pledged to enhance border enforcement measures. February 4th, the 10% tariffs on Chinese imports went into effect, and China retaliated with tariffs of 15% on US coal and liquefied natural gas and a 10% tariff on oil and agriculture machinery. March 4th, US implemented the 25% tariffs on Canadian and Mexican imports, but limited the tariff to 10% on Canadian energy. Both countries promised retaliatory tariffs. March 5th, President Trump announced a 1-month exemption from the new tariffs for US automakers importing from Mexico and Canada. March 6th, the US postponed tariffs on most products from Canada and Mexico for 1 month. And here's where things get interesting. March 10th, Ontario increased electricity export prices by 25% in response to US tariffs. March 11th, President Trump responded by increasing tariffs on Canadian steel and aluminum imports from 25% to 50%. And a few hours later, Canada suspended the electricity surcharge. And I think that gets us all caught up. So the recent sell-offs that we've seen in the market are partially in response to the uncertainty of how these trade wars are all going to pan out. It's a big disruption to economic growth, in the short term at least, and of course, corporate profitability. We saw a similar market reaction back in Trump's first term in 2018 with the trade war with China. And so this is not unexpected. So tariff and trade, reason number one. Second reason I believe the market is spazzing out a little bit is the pending government shutdown. The government only has approved funding through Friday, March 14th. Continuing resolution needs to be passed to temporarily fund the federal government until a formal appropriations bill can be enacted. Now, back in October, there was no appropriations bill that was passed, so they passed a CR to get through the election until December, and then that got pushed to March after the inauguration. Now that's potentially getting pushed again until September to provide time for President Trump to get his bill through. If the proposed CR passes, government spending continues at current levels. If it doesn't pass, a government shutdown will occur until new funding legislation is enacted. Betting markets are predicting a 49% chance of a government shutdown, at least when I'm recording this. So we'll see. Now, government shutdowns are not actually that uncommon. They've occurred more than 20 times since 1976. Most of the time, they're pretty short-lived and have no predictable impact on the stock market, interestingly enough. Vanguard put together this chart showing the returns of the S&P 500 during the past 21 government shutdowns. The range of historical outcomes is actually pretty wide. Back in 1979, it was down 4.4%, but the most recent government shutdown in December of 2018, the market was actually up 9.3% during that period. Throughout the last 21 government shutdowns, 9 have resulted in negative changes to the stock market, 11 have resulted in positive changes, and 1, the market was closed. But with all this talk of government spending, this could be playing a role in the market volatility as well. Now, one final thing I want to mention that I think is playing a role before I get to the more optimistic part of all this. I think Trump's relationship with the media is playing a factor as well. So he loves being in front of the camera. He loves being in the news cycle. He's constantly doing interviews. I think we've seen more of Trump over the past 6 weeks than we did with Biden over the past 4 years. There's probably pros and cons to that. But with Biden, it seemed like any kind of policy announcement or updates came in the form of a formal press release, either written or in a formal address. And they didn't even happen like that often. With Trump, he's in front of the camera all the time and posting on Truth Social all the time. And you really never know what you're going to get. I think a lot of it is just his personality, but a lot of off-the-cuff statements, and the market reacts to those. So like a perfect example of this, which I think played a big role in the most recent sell-off earlier this week, is when Fox News, Maria Bartiromo, I think that's how you say it, she asked President Trump if he was expecting a recession this year. Here's how Trump responded.
I hate to predict things like that. There is a period of transition because what we're doing is very big.
So he didn't decline a possibility of a recession, and the market reacted in kind. You just don't know what you're going to get. He's very unpredictable, and the stock market likes predictability. When we get things that were not previously predicted, that's when we see movements in the market, which is what we're seeing today. Now, what it looks like moving forward, this is not a prediction that people should make investment decisions on, but I think it's going to be a bumpy ride, if I had to guess. I think it's going to be a little bit before we see the full impact of his policies on tariffs, immigration. We haven't even seen a full tax bill yet. So I'm expecting a lot of ups and downs this year. But on a more positive note, and just a few friendly reminders, drawdowns are normal and expected. Since 1980, investors in the S&P 500 have experienced an average drawdown of 13.6% each calendar year. Despite the drawdowns in a given year, the S&P 500 ended the year positively in 58 of the past 74 years, averaging an annual return of 11.6%. So it's important to expect this. It's the price you pay to get those long-term returns. But let's just say we don't end the year on a positive note and that we do enter a bear market. Typically, they don't last near as long as bull markets, although it doesn't feel like that while we're in them. But you typically have these rough waters that are followed by a strong bull market. So since 1942, the average bear market lasted about 11 months with an average cumulative loss over that period of 31.7%. And an average bull market lasted 4.3 years with an average cumulative gain of 149.2%. So while it is painful to see your accounts drop, you usually get rewarded if you can ride it out. Now, of course, it's a different story if you're living off this money while the market is tanking. Strategically managing risk becomes a lot more important when you're in that distribution phase rather than the accumulation phase. But all that is to say, recovery normally happens pretty quick. These are the previous stock market crashes and the time it took to reach a new all-time high from its lowest point. Even the worst in recent history, 2008, with a near 60% drawdown, it was back up to a new all-time high within 4 years. Now, there's a catch to all this. You have to ride it out. Missing some of those best days following a recovery can really tank your long-term return. For example, over a 20-year period, if you miss the best 60 days over that period, that's just 2 months of sitting on the sidelines during a phenomenal recovery period, your average return over that period, the 20-year period, is 93% lower than it would be had you just kept it in. So your average return over that 20-year period from just sitting out those 60 days goes from 11.6 per year to 6.3% per year. That is the cost of panicking and missing the recovery. It's just such a gamble to get out and then try to hop back in when things get better, because you could have just missed your shot at a huge recovery with once in a lifetime returns. Again, with a disclaimer that your portfolio aligns with your risks, goals, timeline, etc. So here's what I'm doing for myself and my clients. I'm not making any big movements. I rebalance when necessary to get back to my target asset allocation. I tax loss harvest when the opportunity presents itself. I'm not buying and selling asset classes based on these short-term market movements. I'm dollar cost averaging by continuing to invest my money in the market as it trends downwards. This is a great opportunity to buy shares cheaper than they were last week, and especially cheaper than they were last month. And I know I'm going to get the benefit of that when it recovers. And I'm doing my best to be patient. I hate seeing the market go down in my accounts. I especially hate to see it in client accounts, but we plan for this. My financial plans already factor in market crashes, so this is expected and normal, and it's planned for. It just feels bad while you're in it. So remind yourself that it's a long game, and this is the price of admission to get the market returns needed to one day be financially free.